What if I told you that the biggest reason traders fail has nothing to do with strategy, charts, or indicators, and everything to do with what's happening inside their own head? Think about it. Two traders can use the same system at the same time in the same market, and one walks away a winner while the other burns through their account. Why? Today, I'm going to reveal one of the most hidden but powerful secrets in trading psychology, and by the end, you'll know exactly how the winners think differently from the losers. So if you're ready to stop being controlled by your emotions and finally trade with the mindset of a professional, stay with me till the end of this video, because this is where the real game is played. In trading, markets will always be unpredictable, but your reaction to them doesn't have to be. The most successful traders don't necessarily have a crystal ball for price action. What they have is emotional discipline. This means they can control themselves when everything inside them is screaming to act on impulse. Fear and greed are the two strongest forces in any market. Fear makes you exit too soon or avoid taking a valid setup because you're haunted by your last loss. Greed, on the other hand, pushes you to overtrade, chase setups, or ignore your risk rules because you're desperate for that next big win. Both emotions are natural. You can't eliminate them, but winners know how to manage them so they don't dictate their decisions. Think about what happens during a sudden market drop. A trader without discipline sees their position going against them and panic sets in. The mind starts playing tricks. Cut now before it gets worse. They exit at the bottom, only to watch the market reverse right after. A disciplined trader, on the other hand, doesn't let the fear of loss cloud their analysis. They know the difference between a setup that's invalid and normal market fluctuation. They stick to their stop loss, trust their plan, and act based on logic, not adrenaline. But discipline doesn't only apply in losses. It's equally important in wins. After a profitable trade, greed can quietly whisper, "You're on a roll. Double your size. Take one more." This is where losers often give back their gains. Winners resist that temptation. They know that trading is not about hitting a jackpot, but about consistent, calculated execution over time. They take profits as planned, log the trade, and walk away without chasing the high of another quick win. So, how do you actually build this kind of discipline? It starts long before you click buy or sell. The best traders create a clear trading plan before they even open their platform. They define exactly what conditions need to be met for an entry, how much they will risk, where they will exit, and under what circumstances they will walk away for the day. This removes most of the emotional decision-making because the rules are already in place. Without a plan, every market movement feels personal, and your emotions will constantly pull you in different directions. Another tool winners use is position sizing. By risking a small, consistent percentage of their account on each trade, they avoid the psychological pressure that comes with putting too much on the line. If you risk too much, every tick against you feels like a threat to your survival. That's when fear hijacks your thinking and makes you abandon your strategy. But when your risk is small enough, you can think clearly, even in volatile conditions. Discipline also comes from self-awareness. Many traders underestimate how much their personal mood, energy levels, or even outside stress can affect their trading. A disciplined trader keeps a trading journal, not just for market setups, but for their own emotions. They note when they felt anxious, when they broke their rules, and why. Over time, this self-reflection becomes a powerful feedback loop, helping them identify emotional triggers and avoid repeating mistakes. It's also important to understand that discipline is a muscle. You can't just decide to be disciplined one day and expect it to stick forever. You have to train it daily. This means walking away when your plan says you're done, even if you see a tempting setup. It means accepting a loss without revenge trading. It means celebrating the fact that you followed your rules, even if the trade didn't work out. Winners judge their success by their process, not just the outcome. One of the hidden truths is that emotional discipline is not about removing emotions entirely. It's about separating your identity from your trades. Losers often take a losing trade personally, as if it's a reflection of their worth or intelligence. This emotional attachment makes them defensive, stubborn, and reactive. Winners see each trade as just one of thousands they will take in their career. A loss is just data, information to refine the system, not a personal failure. And here's the mystery most people never realize. The market is designed to test your discipline. It will tempt you with sudden spikes, scare you with fake breakdowns, and punish hesitation. Most traders lose not because their strategy is bad, but because they can't stick to it when the heat is on. The winners? They know that the real battle is not with the market, it's with themselves. So, the next time you feel fear or greed pulling at you, remember, those emotions are not signs that something is wrong. They are simply signals, reminders that you're human. The difference between winners and losers is not whether they feel these emotions, but whether they let them control the trade. The winners master themselves first, and the profits follow naturally. In trading, the line between logic and emotion is far thinner than most traders realize, and cognitive biases are the invisible forces constantly pulling that line out of shape. These mental shortcuts, built deep into human psychology, can subtly guide a trader's thinking toward decisions that feel rational but are rooted in flawed perception. The difference between winners and losers often lies in how aware they are of these biases, and how well they control them before they dictate action. One of the most destructive is confirmation bias. This bias locks a trader into a single perspective. Once a trader forms an opinion, for example, that the market will rise, they naturally begin seeking out information that confirms that view, while filtering out anything that contradicts it. They focus on bullish indicators, positive news, and supportive analysis, while dismissing or ignoring bearish data. The result is a distorted view of reality, where the market appears to agree with them no matter what. Professional traders fight this bias by deliberately searching for opposing evidence, challenging their own ideas, and staying open to the possibility that their original read of the market is wrong. Another common trap is loss aversion, the tendency to fear losses more strongly than valuing equivalent gains. This psychological imbalance makes traders hold on to losing trades far longer than they should, hoping the market will come back just so they can avoid accepting a loss. At the same time, it pushes them to take profits too early on winning trades, fearing the gains will vanish. This creates an upside-down risk profile, small wins and large losses. Traders who inconsistently accept that losses are a natural part of the game. They predefine their risk with stop losses and stick to them, seeing each loss not as a threat, but as an ordinary cost of doing business. Recency bias is another silent influencer. It leads traders to give more importance to recent results than to long-term data. A trader coming off a string of wins might feel unstoppable, increasing their position size and relaxing their discipline, convinced a hot streak will continue. Conversely, a trader facing several losses in a row might avoid valid setups or take overly cautious positions, assuming the bad run will keep going. In both cases, decisions are based on short-term emotions rather than a statistically sound strategy. Winning traders treat each trade as an independent event, unaffected by the outcome of the last one. Overconfidence bias is closely related but has its own dangers. A few profitable trades can inflate a trader's sense of skill, leading them to believe they've mastered the market. This false sense of security causes them to cut corners, skip parts of their analysis, or over-leverage positions. The market has a way of humbling such overconfidence quickly and often brutally. Skilled traders protect themselves by maintaining humility and acknowledging that no matter how good they are, any trade can fail. They see discipline, not ego, as their true edge. Anchoring bias works in a subtler way. When a trader latches onto a specific number, such as their entry price, they often make decisions based on that anchor instead of current conditions. For example, if they bought at $50, they might hold a losing trade simply because they wanted to return to that price, even though the market's fundamentals or technicals have shifted. The anchor becomes an emotional reference point, blinding them to the reality of the present. Traders who avoid this bias focus on what the market is doing now, not where it's been, or what they wish it would do. The gambler's fallacy is another dangerous mental habit. It's the belief that if something has happened more often than usual in the past, it's due to happen less in the future, or vice versa, even when the events are independent. For instance, a trader might think that after 5 losing trades, a win is bound to happen soon, and take a low-quality setup just to chase that expectation. Others, after a streak of wins, might assume they're on a roll and take unnecessary risks. In reality, Each trade's outcome is determined by current conditions, not by the streak before it. The sunk cost fallacy can trap traders in bad decisions for far too long. Once they've invested time, money, or effort into a trade or strategy, they resist abandoning it, thinking that doing so would waste their investment. In truth, clinging to a bad position or failing method only deepens the loss. Successful traders are ruthless in cutting off what isn't working, no matter how much they've already put in. What makes cognitive biases so dangerous is that they often operate together. A trader might open a bad position because of confirmation bias, refuse to exit because of loss aversion, focus on their entry price due to anchoring, and justify it all through the sunk cost fallacy. By the time they recognize the problem, their capital and confidence are both heavily damaged. The way winners separate themselves is by building structured processes that limit the influence of these biases. They use checklists before entering trades, follow strict risk management rules, and keep detailed journals of not only their trades but their emotional state at the time. Reviewing these journals allows them to identify patterns of biased thinking and correct them. Cognitive biases are part of human nature, and no trader can completely eliminate them. The goal isn't to erase them, but to manage them, to build systems and habits that make it harder for biases to hijack decisions. In the end, the greatest edge in trading isn't a secret indicator or an advanced algorithm. It's the ability to see the market clearly, without the distortions of your own mind, and act with discipline even when every instinct pushes you in the wrong direction. That's how winners stay in control, while others lose to forces they can't even see. In trading, it's tempting to judge yourself purely by how much money you've made or lost. This is a mindset that keeps most traders stuck in an endless loop of chasing quick wins and avoiding discomfort at all costs. The problem is, the market doesn't reward impatience. It doesn't care about your short-term goals, your streaks, or your need for instant validation. Traders who focus only on results become reactive, emotional, and inconsistent. The real professionals, the ones who last, build their careers on a process-oriented mindset. They understand that success in trading is the product of consistent actions repeated over time, not the outcome of a single lucky trade. This shift begins by redefining what a good trade actually means. For most beginners, a good trade is one that makes money, and a bad trade is one that loses money. But in reality, a winning trade that violates your rules is a bad trade, and a losing trade that follows your system perfectly is a good one. The market is full of randomness. Sometimes bad decisions get rewarded, and good decisions get punished. Winners don't let this randomness distort their judgment. They measure success by how closely they stuck to their process, the rules they've tested and committed to, regardless of the immediate outcome. A process-oriented mindset forces you to prepare in detail before the market even opens. Professionals know their setups inside out, define their risks in advance, and have clear exit strategies. They create a structured trading plan for the day, outlining exactly what conditions must be present for a trade to be valid. This pre-commitment drastically reduces emotional decision-making in the heat of the moment. Without such preparation, traders rely on gut feelings, which are often just emotional impulses disguised as intuition. Following a process also helps combat the most dangerous enemy in trading: inconsistency. Many losing traders change their approach too often, jumping from one strategy to another whenever they hit a rough patch. This constant switching means they never truly learn or refine a system, and they stay trapped in a cycle of starting over. Winners understand that no strategy works all the time. They stick with a tested approach long enough to see the edge play out, making adjustments only based on solid evidence, not short-term frustration. A critical part of a process-oriented approach is journaling. This isn't just about recording entries and exits. It's about capturing the reasoning, the emotions, and the market conditions at the time of each trade. Reviewing this data reveals patterns in both the strategy and the trader's own behavior. Over time, these insights allow for targeted improvements. A trader might discover they consistently break rules after a winning streak, or take lower quality setups late in the day when fatigue sets in. Awareness of these patterns is the first step toward eliminating them. Risk management is another pillar of process-driven trading. Instead of focusing on how much they can make, professionals focus on how much they can afford to lose while still staying in the game. They size positions based on a fixed percentage of their account, maintain a consistent risk-to-reward ratio, and protect themselves from the psychological pressure that comes from overexposure. When risk is controlled, it's easier to follow the process without fear clouding judgment. Patience is perhaps the most underrated aspect of this mindset. The market is full of noise, and there's always another candle, another fluctuation, another temptation to jump in. Traders without a process often feel the need to be in a trade constantly, as if sitting on the sidelines is wasting time. Winners know that the best trades don't come every minute. They're willing to sit out, sometimes for hours or even days, until the exact conditions they plan for are present. This patience is not passive. It's active discipline, the deliberate choice to wait for high-probability opportunities. Detachment from results is what keeps process-oriented traders stable through both winning and losing periods. A trader who defines themselves by short-term results will feel invincible after a string of wins and crushed after a string of losses. Both states are dangerous, leading to overconfidence or fear-driven hesitation. The trader anchored in process rides out these fluctuations with far less emotional volatility. They know that the outcome of any single trade is irrelevant compared to the long-term performance of the system. This mindset also builds resilience. Losses are inevitable in trading, but for someone focused only on outcomes, a loss feels like failure. For a process-driven trader, a loss is simply feedback, a chance to check whether they follow the plan, and, if so, whether the plan itself needs refining. This reframing turns setbacks into learning experiences instead of emotional blows. Over months and years, this resilience compounds, allowing them to keep operating at a high level when others burn out. Ultimately, the process-oriented trader plays a different game than the result-oriented one. The result-oriented trader is chasing dopamine spikes from quick wins, riding emotional highs and lows, and constantly reacting to the market. The process-oriented trader is building a track record, refining an edge, and thinking in probabilities rather than certainties. They understand that the job is not to win every trade, but to execute every trade according to plan, and to trust that the statistical edge will do the rest over time. The difference may sound subtle, but it's what separates the traders who survive and thrive from those who fade away. A result-focused trader might have lucky streaks, but the process-focused trader builds a career. One relies on chance. The other relies on repeatable, disciplined action. When the chaos of the market tests both, only one remains consistent enough to come out ahead. In trading, patience and risk management are not just desirable traits. They are survival tools. The market has a way of rewarding those who can wait for the right moment and punishing those who rush in without a plan. Many traders focus almost entirely on finding the perfect setup or predicting the next big move. But even the best analysis means nothing if you lack the discipline to wait for the right conditions and the ability to protect your capital when you're wrong. The most successful traders understand that trading is a game of probabilities, and both patience and risk control are what allow those probabilities to work in their favor over time. Patience in trading is not simply doing nothing. It's an active decision to avoid taking low-quality trades just to feel involved in the market. Impulsive trading, driven by the fear of missing out, often leads to overtrading and poor decisions. The patient trader, on the other hand, is comfortable sitting on the sidelines, waiting for their strategy's criteria to be met before committing capital. They know that the market will always offer more opportunities and that jumping in too early can mean taking unnecessary risks that erode both confidence and the account balance. This patience extends beyond just waiting for entries. It also applies to holding trades for the full duration of a planned move. Many traders exit too early, either out of fear of losing profits or the excitement of locking in a quick win. But cutting winners short limits long-term profitability. Skilled traders give their setups the time they need to play out, trusting their analysis rather than reacting to every small fluctuation in price. This doesn't mean ignoring warning signs, but it does mean resisting the urge to constantly interfere with a trade that's still aligned with the plan. Risk management works hand in hand with patience. Even the most patient trader will eventually face losing trades. It's inevitable. Without risk control, a single bad trade or a short string of losses can wipe out weeks or months of hard-earned gains. Professionals never allow a single position to jeopardize their trading career. They determine position size based on a fixed percentage of their account, ensuring that no trade, no matter how certain it seems, has the power to cause devastating damage. This disciplined approach to risk allows traders to think more clearly. When you're over-leveraged, every tick against you feels like a threat, and that fear leads to irrational decisions. Moving stops, exiting too early, or holding on to losers in the hope of recovery. By keeping risk small and consistent, you take the emotional weight out of individual trades. This frees you to follow your plan with objectivity, knowing that any single outcome is just one of many in the bigger picture. Another key part of risk management is understanding and accepting that losses are a normal cost of doing business. Too many traders view a losing trade as a failure rather than a natural part of the statistical process. This mindset leads to revenge trading, taking impulsive positions to immediately win back the loss. Patience, combined with realistic understanding of probabilities, prevents this self-destructive cycle. The best traders can take a loss, step back, and wait for the next valid setup, rather than forcing action out of frustration. Protecting capital is not just about surviving losing trades. It's also about ensuring you have the resources to take advantage of the best opportunities when they appear. If you've blown a significant portion of your account chasing bad trades, you might not have the financial or emotional capacity to fully capitalize on a high-quality setup when it comes. Patience keeps you from wasting your ammunition on low-probability trades, and risk management ensures you have enough ammunition left to trade effectively when the real opportunities arise. Time frame discipline is another subtle but powerful form of patience. Many traders fail because they constantly jump between time frames, chasing signals that don't align with their strategy. A patient trader sticks to their chosen time frame and strategy rules, resisting the temptation to enter based on noise from smaller or larger charts. This focused consistency keeps them aligned with their edge, while impatient traders scatter their attention and dilute their performance. Over the long term, patience and risk management work together to smooth out the emotional roller coaster of trading. Without them, traders ride extreme highs during winning streaks and crushing lows during losing streaks, making it nearly impossible to stay consistent. With them, the focus shifts from trying to win big, quickly to steadily building results over time. This steady approach is what allows winners to stay in the game year after year while others burn out. The truth is, trading is less about predicting the market and more about controlling yourself while the market does what it does. You can't force the market to give you a winning trade, but you can control how much you risk, when you choose to enter, and whether you wait for your setup instead of chasing price. Patience is the discipline to do nothing when there's nothing to do. Risk management is the discipline to survive when things go wrong. Together, they form the foundation that all long-term trading success is built on. When you commit to these principles, you begin to see trading differently. You're no longer desperate to catch every move. You stop measuring your worth by the outcome of the last trade. You start thinking like a business owner, where protecting capital and following a process of priorities and profits are the natural result of doing those things well. This mindset shift is what separates those who treat trading like a gamble from those who treat it like a profession. And in the end, the market will always favor the trader who waits patiently for the right moment and manages their risk with absolute discipline over the one who tries to rush success. In the end, trading success is not built on a single holy grail strategy, a lucky market call, or a secret indicator. It's built on the invisible foundation of psychology, the way you think, react, and adapt under pressure. The difference between winners and losers is rarely about knowledge alone. It's about discipline in moments of fear, clarity in moments of greed, and patience in moments of uncertainty. Winners understand that the market is a mirror, reflecting their strengths and weaknesses back at them. They accept that mistakes will happen, but they use them as lessons, not excuses. If you truly want to separate yourself from the crowd, you must go beyond technical analysis and market news. You must master your emotions, challenge your own mental biases, commit to a process-driven approach, and respect the power of patience and risk control. This is the real work, the hidden work, that shapes a trader's future. Every chart you analyze, every trade you execute, every decision you make is an opportunity to either let your psychology control you or to control it yourself. Choose the latter, and you're not just trading the markets. You're mastering yourself. That's how winners are made.